So today we'll go into the second lecture of the sixth module, that is fundamental analysis. Here I'll be discussing about economic analysis. The broad topics which I would be covering in this particular lecture is the introduction to economic analysis, what are the key focus areas, uh, and within that focus area, the factors which can have an influence in doing economic analysis, that is GDP growth, inflation, interest rate, unemployment, exchange rate, the government fiscal policy, monetary policy, and what are the other indicators which is used in forecasting, and the importance of economic analysis for the whole study. What do you mean by economic analysis? So, economic analysis, as the name suggests, it is considered to be a broad economic, it examines the broad economic environment. Why we call it as broad economic environment? It is because economy, in a nutshell, if you are going to say, it talks about the whole country. Okay, how the country is so performing. So let us assume I'm talking about India. So India as a whole, what is the economic condition? So that is why it is a broad economic condition. If I'm going to again split this, I can talk about how companies are working in UP, how companies are working in Delhi, how companies are working in Maharashtra. Like that I can divide. So uh, not that into the picture. I'm taking country as a whole. That is why we consider economic analysis to be a broader economic environment. And what does this broader economic environment do? It does certain activities or how the companies are performing within that particular environment, and what are the macro as well as microeconomic factors which can have an impact on the performance of companies. So when I'm majorly we will be concerned about the macroeconomic factors, though to a certain extent money flow or monetary policy we are taking into consideration, which can be considered part of microeconomic factors. Okay, and why economic analysis is required? Because when we talk in economy as a whole, there could be a shifting consumer behavior where the consumers may have different interests, prevailing interest. The prices could be one of the other factors which the population may look into, like that, quality of products. So you can have n number of factors like this which can have an influence on the consumer demand. The second important factor of economic analysis is the interest rate. So when I'm talking about interest rate, it is the interest rate prevailing in the country, and for a common man, it could be the interest rate which the bank is providing. Okay, so this sometimes the savings rate, interest rate, we can consider it as risk-free rate of return. Though from an economic point of view, this may not be the risk-free interest rate. It could be the rate at which the treasury bills are actually auctioned. So that could be the difference between the face value and the auctioning value of the treasury bills could be taken as the risk-free rate of return. But for an individual like you and me, where the best return I can get is the return from the savings bank account, so I can keep that interest rate as the risk-free rate of return. So this is another important aspect which we will be covering in this particular analysis. The third one is inflation rate. So inflation has an important aspect whenever we do analysis of an investment climate. Why it has an important role is because let us assume that the inflation rate is 8%. In a nutshell, it means to say that a 100 rupee note in your hand is actually worth only 92 rupees because of 8% interest rate which is prevailing. So whatever I'm going to purchase by giving 100 rupees is actually worth only 92 rupees. The remaining 8% is the inflation rate. So the prices are likely to change because of changes in the inflation rate, and it could be the increase in the prices which is likely to happen because of inflation, or decrease in prices because of deflation. So it is majorly concerned about the purchasing power. Concerned about the purchasing power. Next important aspect is the profitability, corporate profitability, whether the company is functioning within a particular environment is making profit or not, and if it is making profit, then which is the best corporate in which I can invest in. So if the economy is good, then it means to say that the major thrust area which the economy has, those firms would be making profit. So let us assume that the focus area of the government is on infrastructure development, then you can obviously see that the infrastructure dependent companies would be making profit. So those companies which are related with dam construction, those companies which are related with road construction, similarly it could be housing plants and other things, cement, steel industry. So all these would be doing a good profit in such economies where you have focus on infrastructure development. So this is something which we can understand by taking into consideration the key sectors which has a role to play in economic analysis. Here the focus area, I've just talked about 4 over here, but while discussing, I'll be having more than 4. As I told you in the first slide, we would be talking about the GDP changes which is likely to happen and how it can have an influence in deciding with whether to invest or not. The second is inflation, whether inflation will have any impact on my decision making, whether to put my money in this particular economy or not. The interest rate prevailing in the country, the employment rate, whether the unemployment is high, low. Based on that, again, I can take a decision whether the economy is going in the right direction or not. So like that, there are many factors. Apart from this, you have Forex and other things which we'll touch upon as we proceed. So let us take one by one. The first one is GDP, and how GDP is going to have an impact on investment. What do you mean by GDP? GDP is nothing but it is the total value of goods and services produced within the country. So basically, for a layman, GDP talks about how much things has been produced within the country, whether it is goods or whether it is services. So in total, the total number of goods produced within the country is considered to be GDP. And within this particular GDP, it can go high or whether it can come down. So based on whether it is going up or down, we can consider the health of the economy and the corporate functioning. So if the GDP growth rate is high, it says that the economy is healthy. You have a healthy economy and the corporate's earnings are also increasing. So if these two things are going together, then we can say that it is the best time for you to make an investment. So it's always better to put your money in an economy which has a higher GDP growth rate. The reason being that a higher GDP growth rate talks about a healthy economy, and in a healthy economy, you can have a higher corporate earning, and since the corporates are earning higher, you can put your money into those stocks. If suppose the GDP is going down, as I mentioned over here, then it means to say that the economy is in a slowdown pace. So which means the production level is less. So when the production level decreases, automatically there will be a reduction in the profitability of the company. And when the profitability of the company decreases, then it means to say that there is a risk by putting your money into those markets. So ultimately, it says that in a economy which has a low GDP growth rate, it is pointing towards a situation where the economy is slow moving, the profitability is less, and the return on the investment is highly risky. So these are some of the important factors that you should consider. From the investor's focus, it means to say that it is always better to invest in economy which has a strong GDP, and this would help in the growth potential of investment. So here the investment what we are talking about could be either in shares or it could be in debt instruments. Okay. So basically, whenever we talk about investment, somehow or the other, shares come into our mind. So let us keep that going. Let's assume that the investment in shares is going to be better in a strong economy which has a good GDP growth rate. Second important factor which can have an influence on the economic analysis is the inflation. So inflation is nothing but the general level of price for goods and services. So what do you mean by general level of price of goods and services? So inflation is nothing but from an economic point of view, it says that the flow of money in the economy increases, and when the flow of money increases in the economy, what will happen? The consumers will start purchasing goods. Okay. So start purchasing goods, and when the consumer starts purchasing goods, what will happen? There could be, it can lead to increased production. Okay. And increased profitability. This is one scenario which is likely to happen when I am talking about inflation. So this is good if suppose everything happens like this, but there can be a negative point within the whole thing where I am saying that the money flow increases, the individuals start purchasing more goods. But if suppose the production level cannot be increased, then what will happen? The demand increases and production is either less or constant. Okay. So what will happen? The demand is increasing, production is decreasing. So which means it says that the price level will go high. Price increases. Okay. So this can also happen if suppose the general level of prices of goods and services are going to go high. So when this situation occurs, then we talk about an eroding purchasing power. So which means to say that whatever goods is worth 100 rupees or 92 rupees, I am going to purchase it at 100 rupees as I have given you in the earlier slide. So this is the situation. So positive side is that a moderate inflation is considered to be a good thing when we talk about growing economy. What is growing economy? Growing economy refers to this, where the production capacity of the firms are more, and you can convert that into goods and give it to the consumers who require it. So moderate level of inflation is good. It's whenever you measure inflation, you should understand one point, that zero inflation is never good for any economy. Mild inflation, that is up to 3 to 4% could be considered to be good for a competitive environment, and that can be considered as a moderate inflation. And when it goes beyond that particular level, it may not be good. So it means to say that the negative effect is a high inflation rate will intend to increase the input cost, and this will in turn increase the price of commodity, price of output, and when the price of output increases and you cannot increase the selling price, you keep selling price constant, what will happen? There is a decrease in profitability. So this is something which you should understand, and that is considered to be a negative impact. So what will the investor think whenever there is inflation, whether it is a positive or negative? Positive, there is no problem. When it is negative, the investors would always believe that the company will pass the higher cost to the consumers. So why they want to pass it on to the consumers? So that the profitability increases, profitability of the company increases. Okay, so this is not a scenario in the long run. In the short run, it can happen, but in the long run, it is not likely to go in that manner. So this is considered to be an important aspect which you will have to look into. Next important ingredient which can have an influence when you are doing an economic analysis is the interest rate. So interest rate talks about the cost of borrowing money. So what is the cost at which I am borrowing money? So whenever every fortnightly, when Reserve Bank of India says that whether the interest rate is changing or not, they talk about repo rate. Okay, and the repo rate is the rate at which the RBI is ready to purchase the securities from the bank. So let us assume that the repo rate is increasing by 25 basis points. So this 25 basis point increase in the repo rate will actually be charged from the consumers who are taking loan from the bank, which means a loan which I was able to get at 9% rate of interest has now become 9.25 rate of interest. So the excess part the borrower will have to bear. Okay, so interest rate is nothing but the cost of borrowing, which is usually set by the central bank, and in Indian condition, the central bank over here is nothing but the Reserve Bank of India. Okay. Now let us look into the conditions where the interest rate is lowered. That is from 9% to 8.75%. What will happen when the interest rate decreases? When the interest rate decreases, automatically what will happen? Borrowing increases. You can borrow money from the market or from the bank at 8.75 rate of interest, and I can say that I put this money in the stock market, which is likely to give me 11% rate of interest in the long run. And from this 11%, if I am going to give back 8.75, I have a saving of around 2.25. So this is the earning which I would be having if suppose the rate of interest comes down. So it's can be considered from within the country perspective, or it can be from the from a country where the interest rate is lower. I can take a loan from India and I can invest it in USA if suppose the rate of return on investment is higher. So it can happen in that manner also. And whenever the investment increases in the organization, automatically there are chances of expansion in companies. So that's the indirect effect of interest rate. Whenever the interest rate goes up, what is likely to happen? The borrowing cost increases, and whenever there is a borrowing increase in the borrowing cost, what will happen? individuals will start spending less because you're going to get a personal loan at a higher rate of interest, and you are not ready to pay that higher rate of interest. Then what will happen? My purchase in durable goods will come down, right? Durable goods ko jo purchase karna hai, I'm going to take AC on loan. So what will happen when the loan rate is higher? I automatically decide that this is not the right time, let me wait for some more time, and after that I can take a decision. So what will happen? The consumer spending will come down, and when the consumer spending comes down, automatically it will have an impact on corporate investment. Profitability of the company comes down, investment coming into the company will also come down. So in a nutshell, what is the impact of interest rate on investors' sentiment? Investors' sentiment says that you prefer to invest in interest-sensitive sectors, which is considered to be real estate or other utilities, where I can call durable items to be real utilities, whenever the interest rate is lower. So whenever the interest rate is less, the investment rate of individuals or retail investors would start putting in more money into the economy. So that's the impact of interest rate. Next is unemployment. Unemployment and the labor market conditions can have an impact on the decision-making process when I'm going to evaluate the economy. So what do you mean by unemployment? Unemployment is nothing but there are people living in the economy, but they are unable to find jobs. So which means most of the people do not have an earning source. So when you do not have an earning source, what will happen? Automatically, my spending will decrease. So there is a decrease in spending. So when there is a decrease in spending, automatically profitability of the company will also decrease. So it says that it's not a good environment for me to put in an economy where unemployment rate is very high. So whenever there is a high unemployment, what is likely to happen? It reduces consumer spending and it also hampers the profitability of the company. If suppose the employment rate is higher, then what will happen? The spending rate would increase, so there will be an increase in consumer demand, and more people would be interested in parking their disposable income in the company which is making profit. So that is the idea why you should consider unemployment and labor market when you are studying about an economic analysis. Okay. Now coming to the labor market talks about unemployment in one way or the other, but this also talks about a different condition where I have skilled manpower in a particular area, but companies are not available based on the skill level. So this is a different scenario which can happen, but under normal situation, if you look at the various companies which are coming into a particular economy, it is dependent on the skilled manpower which the economy has. Let us assume the first stage where I told that you do not have the skilled manpower, but the companies are coming. You can consider the IT sector in USA, where you find that IT companies are doing good in USA, but the skilled manpower is not available in USA, so they are borrowing it from India or other countries which has skilled manpower. So this leads to migration. This leads to population migration, where the skilled manpower is getting transferred to a country which is promoting a particular sector, which has a conducive environment for a particular sector. So this is a different scenario. You will have to study it from that angle. So I'm not going in detail into that labor market conditions. There are various things you can talk about when I'm talking about labor market condition in terms of the working hours, in terms of the work-life balance situation which is prevailing in a particular country. So like that, I can divide it and go into a lengthy thing, but I'm not going much into it. I'm just talking mostly about the employment scenario within an economy, where it says that any person would be interested in putting in a money in an economy which has good employment level, and if it has a good employment level, then the consumer demand will increase, and the consumer demand will be reflected in the economic health through the profitability of the company. Okay, so this is the importance of unemployment and labor market. Next important factor what you have is exchange rate and currency fluctuation. So exchange rate, otherwise we call it as forex. What do you mean by forex? Forex is the value of one currency in relation to another. As I told you in my previous lecture, I've told that this can be either a direct quote or it could be a indirect quote. Okay, I'm not going into details of it. So in one way or the other, it says that $1 is equal to 85 rupees. So this is what you mean by an exchange rate. So what is the value of one currency? Value of one currency in relation to another currency. Okay, so that's what you mean by exchange rate. So when there is a fluctuation in exchange rate, and if suppose the exchange rate is considered to be good from the domestic point of view. So let us assume that the rate of $1 has changed from 85 rupees to 80 rupees. So it means to say that the rupee has become strong in comparison to dollar. So whenever the domestic currency becomes strong, what will happen? Exports will become more expensive. Why exports will become more expensive? Because this is not changing. The dollar is not changing. Whenever I'm going to purchase something for $100, earlier I wanted to pay only, I wanted to pay 8,500 rupees. Okay. Now, when my currency increases, automatically what will happen? This will change to $120. And I will be paying something in excess of, it should be 9,600 rupees, right? So this is why we say whenever the strong currency, whenever the domestic currency increases, what will happen? The exports become expensive. Okay, so the goods which I am going to sell outside my country becomes expensive, and because of that reason, the foreign income is likely to reduce. So the demand will start coming down because of increased prices. Okay. If the currency becomes weak, then what is likely to happen? It will increase export as well as foreign earnings, but it will decrease import. Why it will decrease import? Because the cost of purchasing from foreign country increases, right? So this is the reason why, how the impact of foreign exchange or currency fluctuation is likely to happen. So whenever there is a change in exchange rate, what does the investors look into? The investors would put their money in companies with global operation, because you do not have impact of fluctuation in one economy over the price of that particular product. And because of these reasons, the profitability, and you can have a better competitive advantage in the company in which you are investing. Next factor which can have an influence is the government fiscal policy. What does fiscal policy tell fiscal policy talks about the government spending. Okay, and how is the government able to spend? What is the earning source for government? Earning source for government is from the taxes it actually collects from the public, right? So whenever the budget is being presented, you will come across the word fiscal deficit and fiscal policy and other things in picture. It means to say that the government is earning money through two different types of taxation. One is direct and the other one is indirect. What is direct taxes? Direct taxes is nothing but the taxes which is levied on income. Indirect taxes on goods and services. Right? So you have these two types of taxes which is available. So the sources for the government is from both direct as well as indirect sources. They collect this money and this money is used for the welfare of the public. Welfare of the public. What is the welfare of the public? They invest in infrastructure, right? They invest in Swachh Bharat Abhiyan, right? So like this you have health insurance for public. So like that you have n number of schemes which the government is interested in. So from where is the money coming? It is coming from the taxes which the government has collected. So what are the major spendings on which the government will use these money? It could be on infrastructure, it could be on defense, it could be on healthcare and many other aspects whichever sometimes it is not possible for us to understand minutely. Even a small, your PDS scheme, your public distributions system, that is also a scheme through which government spends the money collected through taxes. So taxation, here it talks about the corporate tax policies as well as the individual income tax which we have. When we talk about the corporate tax policy, this has a direct impact on the company's earning, because whenever we are calculating the profit of the company, what is happening is, first I get the earnings before interest and tax. On this I pay interest, and what is remaining is the earnings before tax, and then I pay tax. What is remaining is the profit after tax, and this profit after tax is used to pay dividends to the shareholders. So when the tax increases, automatically profit after tax will decrease. So this is the impact which it can have, the taxation can have on corporate earnings. Okay, so it's always necessary that the government has good or idealistic spending in the economy, and if it is for good, automatically it will favor industries in a cyclical basis, and it will benefit the corporate in terms of their profitability. So depending on the thrust area the government is focusing upon, investors will have to take a decision which is the best industry to put money in. Okay, best industry to park their money. So this is something which is talked about through that. Next is the monetary policy. So I told you this is microeconomic perspective. When I'm talking about monetary policy, it talks about the money supply which is available within an economy. Okay, so I'm not going into the economics part of it. You calculate this as M1, M2, M3, M4, right? I'm not going into those details. I'm just talking in a nutshell, putting all these things together. What is the amount of money which is circulating within an economy? This can have an influence on the interest rate being charged by the banks as per the regulations laid down by RBI as far as India is concerned. So if suppose the money flow has to increase in the economy, then the lending rate should decrease, When the lending rate decreases, money supply in the economy will increase, and automatically it will have an influence on the profitability of the company. So let us look at the impact of the economic condition. If suppose it is a expansionary policy. What does expansionary policy mean? It means having a low interest rate. When interest rate is low, as I told you, automatically what will happen? People will borrow more from the bank, and this borrowed amount can be used for their purchasing, and that can reflect in the economic growth, in the profitability of the company, in turn reflecting on economic growth. In the other way, when the interest rate is low, the corporates borrow more. Both can happen. Individuals can also borrow, or the corporates can also borrow, right? So if suppose the corporates borrow, what will happen? They are going to put this money on long-term assets, and this will increase the production capacity. And when there's an increase in production capacity, it can be converted into goods, and you have an economic growth happening over there. And if suppose you have a contractionary policy where the money flow is curbed in circulation, how can you curb circulation of money? That is by increasing the interest rate. So when the interest rate is increased, corporates will borrow less, individuals will borrow less. So if suppose individuals are borrowing less, what will happen? The purchasing power will decrease. Automatically, the profitability of the company is likely to come down. If the corporates do not borrow much, what will happen? Their long-term investment is likely to decrease, capital assets are likely to decrease, and when there is a decrease in capital assets, automatically what will happen? The contractionary economy is likely to be envisaged over there. What is the impact on company and investment? Low rates, as I told you, it will increase the borrowing, and it will also increase investment, and this is always a good condition for consumers as well as companies. But from the economic point of view, this will lead to increase in inflation, which is not good. So again, the RBI will have to take measures to curb inflation. How economic indicators can be used in forecasting? What are the leading economic indicators which we are talking about? So if everything, whatever we have discussed in the previous slides are on the better side, what will happen? The market price of the stocks will increase. When the market price of stock increases, the return on investment would be better. So the consumer's confidence index will increase. And whenever there's an increase in confidence of the consumers, automatically there would be increase in infrastructure investment as such. What are the lagging investment indicators? The lagging indicators are basically the unemployment rate and the GDP reports, which is likely to happen. So these are some of the other things, and certain other coincident indicators. Coincident indicators, as the name suggests, when one increases, the other one also increases. As I told you, increase in interest rate will decrease the purchasing power, something like that. So it means coincident indicators, as the name suggests, the impact of one on the other. Okay, so simultaneously it has impact on different things. So when the industrial production level increases, it can have an impact on personal income where it is decreasing, because you are spending more money on purchasing the goods. Okay, so what does it mean? It talks about the market timing and where you have to put your money. So as far as companies are concerned, when the companies has to purchase capital assets, what's the best time you can launch a different product because of the availability of money in the market, in the consumers. All these things can be decided based on corporate index. So Finally, what is the importance of economic analysis overall? It talks about the various macroeconomic factors that can have an impact on industry and companies, and this will help the investors to collect information to find out which is the potential investment areas and what are the risks and opportunities involved in it. Okay, so here we are considering long-term investors into the picture, not the short-term investors. So basically, when we talk about economic analysis, it is looked upon from a larger perspective where we say that for in the long run, whether the economy is going in the right direction or not, whether capital investment is happening or not, and all the other factors which we have seen is good. In that condition, we assume that the economy is good for investment, and if it is good, then we go in for the next set of analysis, which we'll take up in the next lecture. Thank you.